Now, by one measure, stocks are massively overvalued, but is this a reason to be worried? Well, welcome to Trading Nation. I'm Susan Lee. Let's get some answers. Mark Tepper, Strategic Wealth Partner. Stacey Gilbert is with Susquehanna. So, Mark, break it down for us. What indicator are you looking at, and how much does it really matter?
The most interesting indicator that I've come across recently is the total market cap of the stock market versus nominal GDP, which right now is at 120%. Over the course of the last 45 years, that has averaged 75%. Now, the issue with that is even if we were to see exceptionally fast growth over the course of the next 8 years to the tune of 8% nominal GDP growth per year, we would still be at 80% market cap to GDP, which still puts us above that long-term average. So there's a lot of valuation metrics that are telling us stocks are overvalued. However, we don't think they're overvalued when you compare them relative to bonds. So if you look at the Fed model really takes a look at the earnings yield of the S&P 500 versus the yield on the 10-year Treasury. And the stock and bond markets are said to be in equilibrium and fairly valued when those two equal each other. Right now on the S&P 500, you've got an earnings yield of about 5.9%, with the 10-year Treasury right around 2.4%. So if anything, relative to bonds, stocks look attractive right now.
Well, Stacey, what do you make of this comparison?
No, I think it's fascinating, and I think you could slice and dice valuation across the board. One of the things I would say, and I know Mark would agree with me here, is that the markets know a lot of the historical information. They know a lot of these metrics, and they say, okay, and move forward. And they're kind of incorporating that into their prices here. You know, we know from a PE valuation here that the S&P 500 looks rich relative to where it's historically traded. That being said, we have a new administration that the hope and the thought, at least being priced into the market right now, is that it's going to drastically change the forward earnings growth here, so that PE is actually the E that's going to catch up a lot here as well. So one of the things I would say, just looking at the market, so this is what I do all day. I stare and try to get a sense of the sentiment that's out there. So let's look at a pullback of 10% over the next 3 months, knowing the information that's out there, knowing that we're going to get through Trump's first 100 days here, knowing that we're going to have an earnings cycle, everything that's happening over the next 3 months. And the market right now is pricing in around a 6.5% probability that we're down 10% from current levels. This is near historic lows. There is not a significant amount of fear being priced in right now. Kind of taking it one step further, let's look out over the next year. What's the probability that we finish the year in a bear market? By bear market, I'm defining a 20% pullback from recent highs. And we're looking somewhere around like 10, 11%. It's not a high probability. Can we touch it? Yeah, we might be looking somewhere around a 20% probability that we touch a bear market this year. But overall, I would say the market is not pricing in a significant concern for this year. Go out 5 years, it may be a different story, but this year I think the market's saying, okay, let's see what happens.
All right. So, well, thanks, Mark and Stacey, for your time, and thank you for joining us on Trading Nation today. I'm Susan Lee.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.